An Introduction to the Indian Stock Market. Mark Twain once divided the world into two kinds of people: those who have seen the famous Indian monument, the Taj Mahal, and those who haven't. The same could be said about investors. There are two kinds of investors: those who know about the investment opportunities in India and those who don't. Although India's exchanges equate to less than 3% of the total global market capitalization as of 2020, upon closer inspection, you will find the same things you would expect from any promising market. Here we'll provide an overview of the Indian stock market and how interested investors can gain exposure. The BSE and NSE. Most of the trading in the Indian stock market takes place on its two stock exchanges, the Bombay Stock Exchange (BSE) and the National Stock Exchange (NSE). The BSE has been in existence since 1875. The NSE, on the other hand, was founded in 1992 and started trading in 1994. However, both exchanges follow the same trading mechanism, trading hours, and settlement process. As of November 2021, the BSE had 5,565 listed firms, whereas the rival NSE had 1,920 as of March 31, 2021. Almost all the significant firms of India are listed on both the exchanges. The BSE is the older stock market, but the NSE is the largest stock market, in terms of volume. Both exchanges compete for the order flow that leads to reduced costs, market efficiency, and innovation. The presence of arbitrage keeps the prices on the two stock exchanges within a very tight range. Trading mechanism. Trading at both the exchanges takes place through an open electronic limit order book in which order matching is done by the trading computer. There are no market makers and the entire process is order-driven, which means that market orders placed by investors are automatically matched with the best limit orders. As a result, buyers and sellers remain anonymous. The advantage of an order-driven market is that it brings more transparency by displaying all buy and sell orders in the trading system. However, in the absence of market makers, there is no guarantee that orders will be executed. All orders in the trading system need to be placed through brokers, many of which provide an online trading facility to retail customers. Institutional investors can also take advantage of the direct market access (DMA) option, in which they use trading terminals provided by brokers for placing orders directly into the stock market trading system. Settlement and trading hours. Equity spot markets follow a T2 rolling settlement. This means that any trade taking place on Monday gets settled by Wednesday. All trading on stock exchanges takes place between 9:55 a.m. and 3:30 p.m. Indian Standard Time, 5.5 hours GMT, Monday through Friday. Delivery of shares must be made in dematerialized form, and each exchange has its own clearing house, which assumes all settlement risk by serving as a central counterparty. Market indexes. The two prominent Indian market indexes are Sensex and Nifty. Sensex is the oldest market index for equities. It includes shares of 30 firms listed on the BSE. It was created in 1986 and provides time series data from April 1979 onward. Another index is the Standard & Poor's CNX Nifty. It includes 50 shares listed on the NSE. It was created in 1996 and provides time series data from July 1990, onward. Market regulation. The overall responsibility of development, regulation, and supervision of the stock market rests with the Securities and Exchange Board of India, SEBI, which was formed in 1992 as an independent authority. Since then, SEBI has consistently tried to lay down market rules in line with the best market practices. It enjoys vast powers of imposing penalties on market participants in case of a breach.